Hey everyone, and welcome to this explainer. Look, if you're a student just starting your journey into the world of accounting, you are in exactly the right place today. We're going to unpack the absolute core of how businesses operate. We're talking about how money is formally tracked, proven, and verified within a company. Think of this as your foundational guide to understanding the literal lifeblood of corporate finance, accounting documents. So let's dive right in and uncover how businesses actually keep their story straight. To start off, I want you to picture yourself as a financial detective. Let's say a manager walks up to your desk and says, "Hey, we just dropped $10,000 on new laptops." As a detective, do you just nod and take their word for it? No way. How do you prove that transaction actually happened? Because without hard evidence, any financial claim a business makes is kind of just a rumor. And in the strict world of accounting, we absolutely do not deal in rumors. We deal in documented facts. To master this detective work today, we're going to follow 6 quick steps: the nature of documents, classifying them, a real case analysis, preparation principles, the circulation workflow, and finally, verification and archiving. Let's kick things off with Section 1, the nature of accounting documents. It's really interesting to see how the law specifically views these records. If you look at Article 16 of the 2015 Accounting Law, an accounting document is defined as a record reflecting a completed economic transaction. It serves as the absolute basis for accounting books. So I want you to stop thinking of this as just boring paperwork. Actually, scratch that. It is absolutely not just paperwork. It's the legal DNA of a business transaction. If the transaction is the crime scene, this document, it's your smoking gun. And that DNA analogy really illustrates why these records matter so much. There are 4 pillars of significance here. First, it's legal evidence. It confirms a transaction went down and is your go-to for resolving disputes. Second, management verification. Managers use these to verify everything is above board before giving the green light. Third, it's your accounting basis. These documents are the sole foundation for recording anything in your books. And fourth, internal control. They are literally the ultimate tool for preventing and detecting fraud. Moving right along to Section 2, classifying documents. A super common question beginners ask is, does it have to be physical paper to count? Well, when we compare hard copy paper documents to electronic documents, which are governed by regulations like Decree 123/2020, the crucial takeaway is this. Whether it's a physical receipt you're holding in your hand or a digital e-invoice sitting in your inbox, both carry the exact same legal weight. As long as they meet the statutory conditions, you're good. The medium changes, sure, but the legal DNA remains exactly the same. Okay, Section 3. Let's look at a real case analysis with Minpat Trading Company. Let's bring this into the real world. Imagine you are the accountant for Minfat Trading. The purchasing department comes to you, super excited, saying they just bought goods from a supplier worth 50 million Vietnamese dong. That is a significant purchase. You've got that massive 50 million dong figure staring you in the face. What exactly do you need to demand from your team to prove this transaction actually happened? To build an airtight case file for this, you're going to need 4 non-negotiable documents. Number 1, the VAT invoice issued by the supplier. That's your primary tax and legal proof. Number 2, the goods receipt note signed by your warehouse keeper proving those physical items actually showed up. Number 3, the purchase order or contract proving management actually authorized this whole thing. And number 4, the payment voucher or transfer order proving the cash actually left your company's bank account. And see how all of this builds to our next major rule? If you are missing even one single piece of that 4-part puzzle, the transaction is legally invalid. I'm going to repeat that because it is literally the most important lesson for a new accountant. A missing document means you cannot, under any circumstances, report that 50 million dong in the accounting books. Your chain of evidence is completely broken. All right, Section 4, document preparation principles. Because the stakes are incredibly high, there are strict rules of the game for creating this evidence in the first place. Think of these as the do not cross lines of the accounting profession. When you prep a document, it has to accurately reflect the true nature of the transaction. Absolutely no abbreviations, no random alterations, and definitely no erasures. You have to use an ink pen, never ever a pencil, because pencil can be erased and changed later. In any blank spaces, you've got to explicitly cross them out so nobody can sneak in extra numbers after the fact. Break these rules, and your evidence is getting thrown out. Next up, Section 5, the circulation workflow. So let's say you've created a perfect, legally compliant document. What happens now?
It doesn't just sit on your desk collecting dust. The workflow moves through 5 distinct stages. First, we prepare the document the exact moment the transaction occurs. Second, we verify it. Think of this stage as a highly strict border checkpoint. If the document has errors or is missing signatures, boom, it's rejected and sent back immediately. If it passes, we move to step 3, approval by authorized personnel. Only after all that do we hit step 4, where the accountant finally records it in the books. And finally, step 5, we archive it securely.
Which brings us to our final stop, Section 6, verification and archiving. After all the action of a transaction is over, the evidence has to be protected in its final resting place. And the law actually dictates exactly how long a business has to protect its DNA. According to Article 41 of the Accounting Law, administrative and operational records have to be kept for at least 5 years. The heavy hitters, like posting documents and financial statements, those must be retained for a solid 10 years. And what about documents of true historical significance to the company? Those are kept permanently. This just ensures that if an auditor or tax authority comes knocking a decade later, your evidence is ready to go. As we wrap up this explainer, I want to leave you with a quick scenario to test your brand new detective skills. Say a business accidentally loses an electronic input VAT invoice. Can they still claim the input tax credit, or do they just lose that tax money forever? Given everything we've talked about today regarding the strict rules of evidence versus the digital nature of e-invoices, how would you argue this case? I want you to really think about it and maybe take this debate to your next class. Thanks so much for joining me on this explainer, and keep exploring the fascinating world of accounting.